You're listening to the Financial Source podcast on YouTube.
Welcome to today's deep dive. How quickly does a geopolitical headline actually physically move global money?
Yeah, that's exactly what we're looking at today.
Right. We have a stack of fresh reports detailing how these escalating tensions in the Middle East are just sending shockwaves across global asset classes, everything from currencies to commodities.
The catalyst here is the very real threat of regional escalation. I mean, Axios reported the UAE is weighing military action following those Iranian drone and missile strikes.
And there was that Israeli official hinting Saudi Arabia might also move against Iran.
Exactly. You put those together and you have the perfect recipe for a massive flight to safety.
You can really see that panic moving the needle instantly. Like the US dollar index ticked up 0.1%.
Which is notable.
Yeah. But the real story is in precious metals. Gold just smashed right through the $5,000 per ounce threshold, pulled silver right up with it. It's wild seeing that historic psychological barrier crossed.
It really is. It highlights the sheer volume of capital looking for a safe harbor right now. But interestingly, the Federal Reserve isn't hitting the panic button just yet.
No, they're maintaining a very measured stance, right?
Yeah, they're signaling their policy is well-positioned. It's simply too early to gauge the actual inflationary impact of this specific conflict.
Sure. Of course, any hint of conflict in the Middle East instantly hits energy markets.
Immediately. WTI April 2026 and Brent May 2026 crude both jumped over 1% right out of the gate. People were definitely fearing supply disruptions.
But that peak was actually short-lived.
Right. Prices eased back from their absolute highs following a major policy announcement from President Donald Trump.
He stated the U.S. would provide political risk insurance, financial guarantees,
and potential maritime escorts for tankers moving through the Strait of Hormuz.
Yes. And looking strictly at the market mechanics, that guarantee clearly injected enough confidence to cool off those immediate supply fears. While energy markets cooled down, industrial metals told a totally different story. I mean, copper surged almost 2%.
And that wasn't driven by fear, that was driven by production. We just saw the strongest private sector manufacturing data out of China in over 5 years. Heavy industry is firing on all cylinders again.
That robust data out of China really clashes with the caution we're seeing elsewhere.
It does, and you see that same fragmented sentiment playing out in foreign exchange.
Right, the euro slipped, hovering just below the 1160 level, and the pound dropped too, finding support around 1330.
Well, that drop in the pound makes perfect sense. You have to factor in the muted UK spring statement. The Office for Budget Responsibility downgraded their 2026 growth and inflation forecasts.
But the real standout was the Australian dollar.
Yes. It actually declined nearly 0.5%.
Right.
And that was despite reporting stronger than expected fourth quarter GDP.
Because the market just completely shrugged off the good news.
Precisely. That GDP data preceded the Reserve Bank of Australia's first rate hike in over 2 years. The broader cautious appetite just swallowed up any positive local momentum.
Meanwhile, the New Zealand dollar edged up 0.1%, and the dollar to yen remained virtually flat.
And the bond market is mirroring this exact divergence. Instead of a uniform rush to fix income, U.S. Treasury futures actually slipped half a tick.
Right, investors are piling heavily into European and Japanese debt for safety instead.
Exactly. Pushing German bonds up 17 ticks and Japanese government bonds up 19 ticks, briefly hitting 133.00.
It's a textbook snapshot of a highly fragile global market.
Investors are walking a tightrope right now. They're trying to balance extreme, high-stakes geopolitical uncertainty with localized, everyday economic realities.
Which leaves you with a really fascinating contradiction to chew on after this deep dive wraps up.
For sure.
Think about this. We have extreme safe haven assets like gold surging past $5,000 an ounce out of sheer caution, while industrial metals like copper are simultaneously rising on the back of Chinese manufacturing growth.
Direct opposites.
Exactly. How will the global economy ultimately reconcile these directly clashing signals of intense fear and rapid growth?